Okay, call the meeting to order. Clerk, call the roll.
Higgerson?
Did you say here?
Say here. Neely?
Here.
Parker?
Here.
Parch? Peddle?
Here.
Tarazinski? 4 present.
We do have a quorum. At this point, I'll open it up for public participation. Seeing none, we'll continue with our agenda. Approval of the minutes, they were included in the packet of the June 26th, 18 meeting.
One correction,
What correction? Go ahead.
Steve hasn't been thrown off the committee, he was absent.
Okay.
Okay. And that correction will be made and will be brought back to the city council. Because it's been more than 30 days. The council approves. Oh, no, wait a minute. That's not true. No, that's not true. It wasn't a joint meeting.
We can
So,
call it scrivener's error, and I can just make the correction, and
yeah.
if you're fine with that.
All right, yeah, that's fine. That's fine. Okay. Any additions or other corrections? Okay, I need a motion to approve.
I have a question.
Yes.
Since I wasn't here.
Yes, you're fine. You still can vote, you
Okay.
still can, yes.
Okay.
Everything. It's one of the quirks in Robert's rules. Yes. So I need a motion.
I move to accept the minutes.
Second.
Okay. All those in favor say aye.
Aye.
Opposed? Abstentions? No. Okay, tonight we have two outside presentations, very important presentations. This is kind of a jam-packed agenda tonight. And we have Brian Lefebvre from Segich with us to talk about the latest comprehensive annual financial report, which would be for FY17. And we also have a representative of our actuarial firm who I'll introduce at that particular time. So I'm going to go ahead and, do you have anything to say before we begin, Bob, or just go ahead and bring it? That's okay. All right. All right, Brian.
On behalf of Segich, I'd like to thank the committee for inviting us to present the report resulting from the audit of the city for your year ended December 31st, 2017. The comments I prepared for you are for the comprehensive annual financial report. And in the presentation, I'll also reference a couple of the other reports where we issued opinions as well. So the comprehensive annual financial report is 3 sections: an introductory section, a financial section, and a statistical section. What's required under Illinois compiled statutes is that the city be audited, and that would include the financial section. What makes the comprehensive annual financial report is the introductory and the statistical section. I won't go through the statistical section in any detail, but it does have a lot of good 10-year trend information. So if the types of things you're looking for from time to time might be like, what's our trend with property tax rates? What's our trend with fund balances in our general fund? You're going to find those things in those 10-year schedules. You'll just have to look for little notes to figure out fiscal year changes and how that impacted the numbers, since we're just early on, this being your first full year with the December 31st year end. In the introductory section, the third document, Roman numeral 3 in that section, is the award that the city received from the Government Finance Officers Association. It's called the Certificate of Achievement for Excellence in Financial Reporting. This is the highest level of financial reporting within the local government industry, and the city has received this for 24 consecutive audits. In addition, we also have received awards for your budget from the GFOA's Budget Award Program, and also a separate document called a Popular Annual Financial Report that we received an award for the June 30, 2016 year end as well. If you turn from there, or just as you're following along in the financial section of the report, The first page in the financial section is on page 1. This is on sickage letterhead. This is where we've given an opinion on the financial statements. In order for us to give an opinion on the financial statements, we follow 2 sets of standards. One are the financial reporting standards issued by GASB, the Governmental Accounting Standards Board, that tells us what the statements and the notes of the statements and even the statistical section are required to look like. Secondly, then, the second set of standards are the auditing standards issued by the AICPA, or the American Institute for Certified Public Accountants. And the AICPA auditing standards tell us the types of procedures we need to perform when we're conducting our audit. So once we follow both of those standards, we can then issue an opinion on the financial statements. We're pleased to present an unmodified opinion. What that means is that the financial statements are presented fairly in accordance with generally accepted accounting principles, free of material misstatement. And this is the highest level of opinion that you can receive on your financial statements. The third page of that opinion makes reference to another report. And when it talks about the top of page 3, other reporting required by government auditing standards, that's a reference to what's called the single audit report. So a single audit is required anytime the city expends more than $750,000 in federal funds. And that separate single audit is a compliance audit. So in that separate document, you would see that the city has expended during the fiscal year 17 over $1,790,000 in federal funds. And as part of that single audit report, we issued 2 opinions. One of the opinions was an unmodified opinion on laws and regulations that could have a material impact on the city's financial statements. And then the other unmodified opinion relates to your compliance with the major programs that were required to be tested this year. That major program that was required to be tested was the Mass Transit Grant Program. Finally, there is also a separate compliance report related to your tax increment financing districts, and we issued an unmodified opinion on your compliance with laws and regulations related to the TIFs. Just past the independent auditor's report is what's called the management discussion and analysis. The management discussion and analysis is required by GASB, prepared by the city. It's an executive summary. So if you don't have a chance to go through the whole CAFR, that's where you want to start, because that's where the city gets to explain some of the whys of its financial statements, comparing this fiscal year with the prior really stub year. But it is the one place in the financials where you can get a little more detail about the whys of what happened financially within the city. The MD&A goes for 13 pages, and after those 13 pages comes the first audited financial statement. It's called the Statement of Net Position. The Statement of Net Position is what I like to refer to as a global view financial statement. It's on a full accrual basis of accounting, so basically you take all of the individual funds that the city budgets and appropriates for, and then you layer on top of that the capital assets and the long-term liabilities of the city, and that's what you end up with, the Statement of Net Position. The Statement of Net Position includes the net pension liability for your pension plans, IMRF, police, and fire pension, and that's what causes your net position to become a negative number in the governmental activities column. Now this statement, along with the following statement, the Statement of Activities, are only presented in the annual audit report. You don't see, that's not how you operate. You operate on an individual fund basis, but in order to receive that unmodified opinion for the audit, you're required to present both the Statement of Net Position and the Statement of Activities. What you'd be more used to seeing begins on page 7, which is the balance sheet for governmental funds. This shows the general fund in the far left-hand column, and then you can see the other individual funds that are presented in separate columns. Those are all major funds as defined by GASB, and so therefore required to be presented in their own separate columns. The focus here being with the general fund, your main operating fund. Fund balance is the amount of reserves. Fund balance is the focus, because fund balance is the amount of reserves you had available to begin the fiscal year you're operating in now. So your total fund balance of the general fund was just over $9,073,000 at December 31st. The unassigned or non-obligated portion was $8,271,000 and change. So how did it arrive to be that number at 12/31? That's what we find on the income statement on pages 10 and 11. GASB doesn't let us call it an income statement, they call it a statement of revenues, expenditures, and changes in fund balances, but we'll all call that an income statement. If we focus on the general operating fund, once again, if you look in the middle of the page, there's a line that says excess of revenues over expenditures. That was a positive $1,230,000. After some transfers in and transfers out, that decreased the amount by $1,385,000. So overall, about a break-even year for the general fund with a decrease of $155,000. Beginning of the year, fund balance was $9,229,000 with $9,073,000 at the end of the year. As I mentioned, that unassigned fund balance is $8,271,793. The target percentage of expenditures and transfers in the city's policy is 25%. It was just shy of that at 12/31/17 at 23.7%. If we turn from there over to page 15, page 15 is the income statement for the Water Airport Refuse Fund, basically what's referred to as your enterprise funds. Enterprise funds present their information always on a full accrual basis, so that's why we don't see those on the same page as the general fund. If you focus, and if you look at the water fund, you can see that the water fund had an increase in its net position of $469,000 for the year. The airport fund now has home rule motor fuel tax coming into that fund, which you can see in the non-operating revenues of $267,000. And during the year, there was some grant activity that flowed through the airport that goes through as a capital contribution of $789,000. And that's not always cash, and sometimes the airport construction that's done is done with the state being the lead and putting those capital assets in. So that contributed to the increase in net position of $490,000 in the airport fund. Page 19 is the income statement for your pension trust funds, which is your police and fire pension funds, which obviously have the separately local boards that are in charge of managing those funds. The statement on page 19 combines both of those funds into one income statement. The individual separate income statements for police and fire can be found on page 137 and 138. But what you'll see on page 19 is that there was employer or city contributions in the form of the tax levy of just over $5,453,000. Active member contributions required under statute of $1.1 million. New money into the plan of about $6.5 million. Net investment income for the fiscal year of $7,431,000. So just shy of $14 million in revenue, with deductions or expenses of $6.7 million, had an increase for the year of $7,241,000. The plan net position, which is all the assets at market value, went from $57.2 million to $64.5 million for the two pension funds combined. The last thing I want to show you is information related to the pension plans, and this will be somewhat repetitive with some of the information Heidi's going to present you, but if you turn to page 85, she'll drill down on some of the details for police and fire. Page 85 has information related to IMRF. So let's just talk a little bit about funding for IMRF versus police and fire. So for IMRF, the individual employees in IMRF have a percentage that comes out of their checks, same with police and fire. How the employer funding is arrived at is much different for IMRF than for police and fire. For IMRF, there's an actuary at IMRF that tells you, here's what your percent of payroll is that you're going to contribute this year, and in your contribution, that overall rate, the city's rate, a portion of that is everyone working another year, which is like the normal cost, and then a portion of it is paying down the unfunded liability. So your overall contribution rate for 12/31/17 for IMRF, you can see on page 85 was 15.33%, that far right-hand column, that bottom number. And you put in exactly what the actuary recommended, because it's statutory each and every month that you have to pay in that rate. So you're always going to see your contribution exactly being the actuarially determined contribution. That differs from police and fire as you turn to page 86, where there's a recommended amount by the independent actuary that's going to talk with you tonight, and then you levy an amount in hopes that you're going to fund what that amount is. In this particular year, it was slightly less than what the actuary had recommended. For police, like about 17,000, for fire about 215,000, but you'd overfunded the year before. But when you look at those percentages relative to the covered payroll, you see 42.6% of payroll for police and 58.1% of payroll for fire. So that's one piece of the health protection plan. The other piece is, what were the results for the year? We saw some of the details on the income statement, but when we break those out, we can see that on page 88. This shows you the two sides of the equation. You've got the liability, what's our liability for all the individuals in the plan, and then we've got the assets, how do the assets perform at market value, which is GASB's required reporting in your financial statements. You can see, if we look at percent funded for IMRF, from 16 to 17, you went from 83% funded to 94% funded, and that was due to the fact that your investment income went from $3 million to $8.3 million. And how do you explain the fact that you don't fund IMRF, police and fire based on that straight market value? Otherwise, your contributions will look like this. However, the market value reporting that GASB requires, you're going to see those large jumps in funded status just because of certain years when the markets do really well or not as well. Page 89 has the results for the last 5 years for the police pension plan, and that went from 47.9% funded to 49.7% funded. For both police and fire, you did have a actuarial assumption change with an interest rate decrease from 7.5 to 7%. Otherwise, you would have seen a lot higher increase in your percent funded there. And then page 90 shows that your fire went from 39.1 to 40.8% funded. The last thing to show you is just as we had implemented a new GASB standard back in 2014, now starting to see 5 years of returns, or 5 periods of returns, if you will, for both police and fire. So you can see for 12/31/17, police had investment returns of 14.21%, and then on page 92, 12.26% for fire. Those were the highlights of the CAFR that I prepared for you this evening. In conclusion, the audit went very smoothly. I've had this date on my calendar to present the CAFR for quite some time, and you should know that there's very professional staff at the city that we work with, both led by the finance department with Molly and Bob, but also all the departments working together, because let me tell you, it's all the departments that have grants and those kinds of things, so we work with everyone, even though the focus always seems to be on finance. So with that, I'd be happy to answer any questions that you might have.
I want to make a couple of comments for the benefit of those who are watching on our video or later look at the reports and correct anything that I say that's not correct.
Sure, I'd be happy to.
First of all, this is the comprehensive annual financial report. The budget is a plan. The comprehensive annual financial report are the results, and they include audited statements. Second of all, as Brian pointed out, there are some government-wide statements that are prepared on a different basis. Those are accrual statements than the general fund might operate under, or some other funds. Enterprise funds are accrual, but some of the other funds are modified accrual. And therefore, what you will find is that because of accounting and auditing rules, a local governmental unit is going to have to keep books, essentially, on different bases that will be used to prepare the statements. And I think that's probably it. The other point, and this will come up again later, is that the statistical section is one of the bases for the 5-year financial plan that we'll be discussing later. And it's the 5-year strategic financial plan is just a matter of pulling some of those things together from disparate sources and putting them all in one place. So it's not necessarily new information, but it's packaged. Are there other questions for Brian? appreciate your presentation.
Thank you very much.
Our next presentation is from our actuaries, who primarily you're dealing with police and fire, correct? Police and fire. This is Heidi Andorfer with Foster & Foster.
Thank you. Thank you very much for letting us come here and present the results of the report. My name is Heidi Andorfer. I'm a fellow at the Society of Actuary and the World Actuary with your fund. And I'm not sure in your packet there if you have the police plan first or the fire plan first. I can go in either order. What are you seeing there first in terms of the reports? The very first
Here.
page.
Police, yeah, that's what I said, police.
We'll leave the police then. No reason to flip back and forth. Okay, so with that, let's turn to page 5 in that report. The page numbers are on the bottom of the pages, bottom right-hand corner. So page 5 is the summary report, and that's sort of our bottom line on top page. You can see here we have a right-hand column that shows you last year's results, and then the left-hand column will show you the current year's results. This is going to be true on any pages you look in the report. The further to the left you get, the more current the results. If you look at last year's number of about $2.7 million, that's increased to about $3.1 million this year. That's about a 15% increase for police. Fortunately, it's a little bit less for fire, but you're still going to see an increase in both funds. That's primarily driven by some of the assumption changes that we did implement this year, and I'll go through what some of those were in another page or two. In addition, the nature of the methodology that you do use to amortize the unfunded piece of the liability has a natural increase in amortization every year. So you're basically guaranteed an increase in this number. All else being equal, you're guaranteed that this number will increase by some amount every year, just due to the nature of the way you amortize the unfunded. So we did expect some of that increase. And then there was also some unfavorable experience over the course of the year. So there was no turnover in the fund, and typically turnover does result in gains. The fact that there wasn't any turnover means there was some losses from that increment. Yep.
Taking this,
Oh,
I'm sorry, Bob.
what
This is
Page
page 5. There is called summary of report. If you have the entire packet, it's 254 out of 499. You there? I think so. Okay. I'm confused. I think I'm sure it's correct, but I'm confused. So when I look at the summary of the report page, okay, and I read what the first paragraph said, it says the regular annual actuarial evaluation of the City of DeKalb Police Pension Fund performed as of January 1st, 2018 has been completed, and the results are presented in this report. Okay. So when I look down at the columns that you have below that with the valuation date, so is the valuation date of 1/1/2017?
It is actually,
No.
go ahead.
If it's 1/1/2017, then that's used for the contributions from 1/1/18 to 12/31/18?
Yes.
Okay, so the one that you just did for 1/1/18 will be what will apply next fiscal year for the proposed calculator.
What you'll levy for the next.
Okay, all right, okay.
Exactly. Yeah, the timing, not every jurisdiction does it that way, but that's typically the way it is. It's sort of a lag because of the timing of when the levy needs to happen.
So, right now,
Right. What you'll
we're seeking 59.4% of the projected payroll right now. And then next year, when we're levying the taxes payable in 2019, we'll be using the figure here, 62.7%.
So you'll be using actually the numbers in the bottom, because remember, we have member contributions that offset that. So we have.
Right, no, I understand, okay. So you'll be using the left-hand column for
What
what is actually paid in 2019.
Right,
And, okay, all right, fine.
yeah. And that
Thank you
can-
for the correction.
That can be confusing because some municipalities don't flag it 2 years like that. I would say the majority do it the way you're doing it.
Okay, all right, thank you.
Yeah, that is very confusing. And those numbers show up, that lag shows up when you look at your GASB results that run
Okay.
up.
All right.
Okay. So in terms of some of the unfavorable experience, the turnover was an issue. The investment return for the year, actually, while the market value returned a higher number, as Brian suggested, we do smooth your assets. So because of our smoothing methodology, you're not going to see those spikes in highs or lows, and so we smooth your gains and losses out over a 5-year period. So you'll see, hopefully, on a long-term basis, something very close to the investment return assumption that we're assuming for the fund, which should be an easier target to achieve now because we did drop that by 50 basis points. And so if we flip actually to page 7 of the report, changes since prior valuation is the label at the top. You can see some of the assumption changes that were implemented. The biggest driver here was that interest rate decrease. We dropped the rate from 7.5% down to 7%. At 7.5%, you were really sort of an outlier. We didn't have many funds there anymore. 7 still puts you on the high end, I would say. I'd say a lot of our funds are still south of 7, but 7 does not put you in an outlier category anymore. And from the perspective of what your investments can support, you are much closer to 7. So I ran some quick math on the GASB disclosure numbers because GASB now requires us to disclose the long-term real rates of return that the investment advisor expects the fund to receive. And when you run a very quick weighted average of target asset class times weighted average expected return, and you run the math by category, in your plan here, and this is more true for fire, police still gets you at a number of 5.27%. However, when I looked at the numbers provided by your investment advisor, they were lower numbers than I would have expected, and I believe that's because they're using a shorter term horizon than what the fire fund is using. So I think if you used a longer term horizon, that 5.27 would stretch out a bit more. I'm not sure if it would get you to 7 or not. That's for Wall and Associates to tell us. They're really the experts when it comes to the long-term rates of return on the fund. But this is something we will be monitoring, and we do check against this assumption every year. So we do feel better about the place that we are. However, dropping that rate 50 basis points did increase the contributions. In addition, we did make some other assumption changes. The second bullet there lists some assumption changes related to salary increases as well as retirement, disability, and termination rates. So some of the demographic tables that were used in the fund. And most of this was driven by a study done by the Illinois Department of Insurance in 2007. So every 5 years, they do a study on all Article 3 and all Article 4 funds separately to determine what real experience has been historically. So they look at what the past 5 years termination experience has been, what the past 5 years retirement experience has been on real Illinois Article 3 and 4 funds. They pool all of that experience and they develop tables that are applicable to all of the funds. We have leveraged those tables. Most funds are not large enough to have their own tables. So we do feel comfortable leveraging the tables based on, your plan was included in that study as well, on that data. So we did update those tables. Generally speaking, that did decrease the contribution. Those tables generally brought liabilities down. So that helped offset a bit, but that 50 basis point change is still really driving the show here. Then the last big change that we made is the fourth bullet down. The payroll growth rate assumption was reduced from 4.5% down to 4%. And the only place this assumption comes into play is when we calculate the amortization payment on your unfunded liability. So this determines how fast and at what rate you're paying down the unfunded liability of your fund. What you were doing is saying every year, whatever the amortization payment is this year, next year it'll be 4.5% higher, and the next year it'll be 4.5% higher. So you can see how over time that would make that contribution go up quite high after a 10-year period, for example. So we reduced that down to 4%. So what does that mean? Well, it means that when we run our calculation on the unfunded now, the contribution today is going to be a little bit higher. I'm so sorry. My husband's picking up my children. I don't know how to do that. I forgot I had that on, so sorry. So what that means is basically now you're saying, okay, we're gonna start off at a higher level today with respect to paying down that unfunded, but it's only going to increase 4% per year. So the curve isn't as steep on how fast that payment's going to spike on you. Ideally, we'd like to see that come down more, but I'm going to illustrate for you how painful this assumption can be to move in a few pages here. So moving down 4% though got us to a much more comfortable place.
Now, I want to make it very clear, if I understand from your previous presentations, that this does not mean that there is an assumption that every police officer is going to get a 4% raise. This is a payroll growth assumption, which is not related to that same assumption.
That is true, because that's our salary increase assumption. That's what applies on an individual basis to build into the liabilities. The only place this assumption comes to play is in the determination of the amortization payment. And what it is trying to mimic is it's trying to say, we want your amortization to be the exact same percentage of your payroll every year. So if you expect your payroll to grow by 4% per year in aggregate, all officers included, if you expect that to grow 4% per year in aggregate, we'd expect the unfunded amortization to be the same percentage of payroll every year.
But in layperson's terms, okay, the payroll assumption, the payroll rate assumption that is made takes into account turnover. It takes into account people who are promoted. It takes into account any kind of union contract increase in wages. Okay. So what I'm saying is somebody can't look at this and say, well, you're promising the union a 4% raise every year. This is a much more general and a much richer assumption.
And it's the whole population, so to the extent
Right,
that
exactly.
people leave, people enter the fund, it's the whole population and how that payroll moves in
Exactly.
aggregate.
Yep.
So it's a much different assumption. Okay, so with that, let's flip to page 9 to get into a few numbers here. Page 9 is going to say C liabilities at the top. And again, remembering the column format, the right-hand column is going to be last year's numbers, the left-hand column is going to be this year's numbers. The middle column shows you what the results would have been had we made no assumption changes. So you can see the impact of those assumption changes on the liabilities and ultimately the contribution in another page or so. So if we look at the numbers last year, you could see that your funded status was about 50%. Having made no changes to the fund, you would have seen an improved funded status that would have gone up to 50.8, so you're moving in the right direction there. However, we did make the changes to the assumptions, which, as you can see, the total actual accrued liability went up from $68.7 million to $71.6 million just due to that assumption change, or the combination of those assumption changes. So because we did increase that accrued liability due to those changes, it did decrease the funded status here down to 48.7. So that's really driven by that interest rate drop more than anything. But we did feel that was a good change to make this year. Okay, so if we flip to page 11. Page 11 is going to say section E pension costs at the top. And this is the page that shows you the details of the contribution calculation. So again, looking at that far left column under the new assumption heading, you can see that that the total contribution, expected city contributions there in the sort of the middle-ish to the bottom of $3.1 million. That is a combination of the normal cost plus administrative expenses. So the normal cost is $1.3 million. What normal cost is it's really the cost of all of your active officers earning one more year of service in the fund. So that's what it costs per year to allow for pension accruals for your active population. So $1.3 million. You add to that the cost to administer the fund. So every year there's cost to administer the fund in terms of training for your board and your trustees, medical analysis on disabled, all sorts of things that can come into administrative expenses. And that will be part of your annual contribution of about $40,000 in this case. If you, in a perfect world, you'd add normal cost plus administrative expenses, and then there where you see expected member contributions of $577,870. If you added the normal cost of administrative expenses, subtracted the member contributions, that's the ideal contribution. If you were fully funded, that's what the city would be funding on an annual basis to maintain the funded status at 100%. However, there are no funds in Illinois in that situation that I work on. There's probably a couple. And so there is this middle line here, which is a pretty big number, the payment required to amortize the unfunded actual accrued liability. That number is about $2.3 million. It's about 75% of the contribution that the city is making. So 75% of the contribution is really to pay down past debt on the fund, past accruals. So the good news is once you pay that off, you're done with that big number, but the bad news is that's 23 years out before we see that number go away. So that's an important thing to know, but that's what the breakdown of the calculation looks like in terms of how we develop the contribution. The other good news on this page is that you're funding pretty close to the recommended amount. So if you look at the city recommended amount in section F there, it was about $2.5 million, and the city actually funded $2.485 million. So pretty close, and generally when it's not matching exactly, it's usually a timing issue for when tax dollars were received. So pretty close to what is being recommended. So as long as you stay on that strategy, that will be better for the fund long term. I mean, we see some municipalities are consistently funding 80%, and they're just digging that hole deeper. So that's a good thing to see that will continue to help get the fund to a better position. Okay, we flip to page 12. This is Schedule H. It'll say Schedule H, schedule illustrating the amortization of the total unfunded accrued liability. So the important thing to point out on this table is this is the projected unfunded actual accrued liability. So the piece that you have that large piece of the contribution attributable to and that you're paying down. So this shows you how that number will change over time. And what's interesting is you'll note it's increasing. So from 2018 to 2019 it goes up, and then in 2020 it goes up again. And it actually continues to go up for a full 8 years before it starts to come down again. The reason this is happening is due to that payroll growth assumption. So the idea is that you are correlating your amortization payment to the payroll of the department, assuming it's a 4% growth. So therefore your contributions now are a little bit smaller, assuming that the payroll of the department goes up by 4% a year, and therefore that contribution will become larger over time. What does this mean when you see this goes up? It means that you're not amortizing any principal yet. You're only paying for part of the interest, not even all of the interest on this unfunded piece. Now this is true of most funds in Illinois, but I did want to point it out because when you reduce the payroll growth assumption, that's where you'll see this relationship change. The lower the payroll growth assumption, the shorter amount of time you're in negative amortization, or perhaps you're not even in a negative amortization situation. And negative amortization basically just means you're not paying any principal. So that's the situation that you're in right now. So that will likely increase next year. Okay, we turn to page 14. Page 14 at the top says development of January 1st, 2018 amortization payment. And we are amortizing right now using a 4% payroll growth assumption. These amounts are as of January 1st, 2018. So when I took the numbers and I showed you the contributions a couple pages ago, those were rolled to the end of the year because we know the timing of these payments aren't on January 1st, 2018. You didn't even have these numbers then. The timing of these are in the next year. So without applying interest and looking at the January 1st calculation, the amortization amount at 4% is $2.144 million. If we were to reduce the payroll growth assumption all the way down to 0%, 0% payroll growth is basically amortizing the unfunded just like you amortize a mortgage on a house. You don't tie the mortgage on your house to your current pay or your future pay. It's the same number every year. 0% payroll growth would mean that. You'd be paying the same number every year, which means shorter term you have to pay something higher so that longer term you don't see those steep increases in its level over time. If you were to decrease to a 0% payroll growth assumption, that number goes up to about $3 million or about a $900,000 increase in the contribution. Pretty painful to move to that. We don't have many funds at 0%. If you were to move it halfway to 2%, that number goes up to about $2.6 million, so about a $426,000 increase in contribution just to move it down to 2. So ideally, ideally, I'd say most funds we're trying to get down to the 3.5%, 3% level where we can. 4% is probably still on a little bit on the high end, but we feel much better about 4% than we did about 4.5%. Okay? So we flip to page 16.
Can we
Absolutely.
stop here? I mean,
Absolutely.
this goes quickly, and so I think it's important to try to work through this. Maybe everybody else understands this. So, is it correct? Okay. All right, I'm still on this page. So, according to this page, how much is the total contribution?
So this page, on page 14, is only showing you the piece of the payment on the unfunded accrued liability. That does not include the normal cost, it does not include the administrative expenses.
Well, what is okay, then what is line 2?
Line 2, so what we do in this calculation is we start, from line 1 is the unfunded last year. So we
Okay,
roll forward to our expected unfunded this year. So to get to the expected unfunded level, we add to it the accruals, which are the normal costs.
oh, okay.
Yeah, and then we roll forward, we add administrative expenses, those earn interest for a year. Then line 5, we get to subtract out our contributions that we make, that reduces the unfunded, and interest on those. And then line 7 gives our expected unfunded.
Okay,
Then the bottom line 11 is the actual unfunded, and so the
Right.
so the 33.4 million is our expected unfunded, 36.7 is the actual
Okay.
unfunded. And
okay,
the two items that make up the difference there are the change due to the assumptions,
Right.
which was about 2.9 million, and the change due to the gain or loss of the fund, and there was a small loss of about 500,000.
okay. And so at the end of page 14, what we're seeing here is that the amortization amount for 23 years of amortization is 2.144 million.
Yes.
And then the recommended contribution would be that plus the normal cost.
Normal cost, administrative expenses.
Right,
And
Normal cost
we
and-
apply interest to the end of the year, because you aren't making this payment on January 1st, you're making it at the end of the year.
correct, okay. And so, okay, I'll ask the question later if I still have it.
No, feel free though.
No, I don't know,
Okay.
if, you may cover it.
Okay, wonderful. So let's turn to page 16. Page 16 says at the top, reconciliation of changes in contribution requirement. And what this shows us is the reconciliation from last year's contribution that we calculated of 2.7 million at the top. And then the bottom line 3 is this year's contribution of $3.1 million. And it shows you the components that changed that contribution. So the big ticket items here are really the assumption change. So that's really driven by two things. The rate change, so we dropped 50 basis points in interest rate, and that payroll growth assumption change. We dropped 50 basis points there as well. And so those two things combined increased the contribution by $257,977.
Okay, now that is just explaining the difference between January 1, 2017 and January 1, 2018.
Yes. Well, in terms of the calculation.
Yeah, the calculation,
Yeah.
okay, all right.
And then the other thing to note on here is the increase in amortization payment due to the payroll growth assumption of $83,615. This one we expect every year. Hopefully the assumption change we don't see every year. We shouldn't have annual assumption changes necessarily. We might have one more next year because there is a new mortality table coming out this fall, and it's likely we will implement that. I can't tell you which direction it will go yet. The table isn't out. Hopefully I'm not sure if I want to say this, because hopefully it lowers the liability, but that means it's saying people are not going to live as long. So I'm not sure what I want the answer to be. But in the end, we will probably see one more change there for some sort of assumption change. Less dramatic because the interest rate and that payroll growth are really going to drive things a lot here.
So this is the 4.5 to the 4.0.
Well, the increased amortization payment due to payroll growth assumption is just the annual increase of 4% that we expect to happen on an annual So every year, that amortization payment is going to go up, and we know that that's part of the change in the contributions.
Oh, I see, okay.
So
So
that's-
it's the increase due to the payroll growth assumption, not the increase due to the change in the payroll.
Right. So basically, what I wanted to point out is every year you could expect somewhere around an $80,000 increase in the contribution, all else being equal.
That's attributable to the payroll growth assumption.
Right.
Okay.
Okay. So the next page I want to show you is page 18. This one is labeled at the top, projection of benefit payments. And the couple of things that are important to look at here are, so basically, let me describe what this page is showing you. This is showing us, based on all of the current population, assuming no future entrants, just looking at who's in the plan today, because that's who the assets are going to support right now. So looking at who the plan is covering right now, all of our demographic assumptions and applying those, assuming people retire when we expect them to, terminate when we expect them to, die when we expect them to, assuming all of those things come true in this table, we look at the payments for our current actives. So the actives, once you're an active today, you stay in this column even when you become retired, and you can see how those payments are going to grow, because obviously your actives over time will retire and start taking benefits out of the fund. The next column is payment for current inactives. So we take our inactive population and we project out what we expect their benefit payments to be annually, and you can see over time those go down because the only way to leave this column is through death. So that's going to decrease over time. We add those two columns across to get the total expected annual benefit payments that will be drawn from the assets of the fund. You look at the expectation in 2018, we expect about $3.2 million of benefits to be paid out during 2018. And what I like to do is look at how does that compare to your assets today. In your case, it's about 9% of the market value of assets, which is not a bad place to be. I've seen some funds where this number is 25% of the assets, and they have to worry a little bit more than you. 9% is a comfortable place to be, as long as your advisors understand what they need to keep liquid so that those payments can be made, and I'm sure they're well aware of these numbers to be able to do that. That's one thing I like to look at. So that made me pretty comfortable with your fund, even though the funded status is south of 50. You look at this and you say, okay, you have some time for your money to work for you. The other thing I like to look at is how long does it take that benefit payment number to double? And in your case here for this fund, it's about 13 years out before we actually see that double. So again, sort of illustrating the point, you have time for your money to work for you. You're not expecting to have to liquidate those assets extremely quickly. And so this schedule kind of supports that you have a bit of time. Time is on your side in this one.
So the current inactives column, is it correct that if the annuitant themselves dies, their pension may or may not come out depending on whether they have a survivor who retains the pension?
That is true, and we have an assumption for that. So we assume 80% of the people have a spouse.
Right.
So that is built in.
And then I would assume that then there's an actuarial assumption based on the spouse's characteristics as to when they would leave the system.
Right, so we actually assume the spouses are 3 years younger. Female spouses are 3 years younger than male. So depending on whether the participant was the male or female will dictate which direction the age goes. And then we actually have a mortality table specific to gender that will apply to that.
Okay, so it's not specific to our inactives, but it's specific to characteristics.
Right, age and gender of the participant.
So that may,
beneficiary.
you're relying on a law of large numbers for that to just kind of even out.
Right,
Okay.
we are. So, any questions on that? So let's look at page 24. Page 24, the big thing I want to highlight here, this page is labeled actual asset valuation. It is the smoothing method that we do employ for the valuation to show you the difference between where the market value is
What
and
was
where the
that
actual.
page was for? I'm sorry.
Oh, I'm sorry, 24.
Thank you.
Yeah, and it says at the top, actual asset valuation.
Thank you.
So on here, this just shows you our smoothing methodology. Basically, we smooth gains and losses over a 5-year period. But what I really want to highlight here is the numbers at the very bottom. Actual asset rate of return of 6.92%, which is shy of what we compared to last year, which was the 7.5% assumption, hence a loss on this. However, in reality, the market value saw quite a gain, so about 13.84. Now, 13.84 is our calculation without timing of things. So it might be, if you look at that, ask the investment advisor to calculate it with real timing of when things came in and out, it might be 13.5 or 13.9, but somewhere in that ballpark. So you did see pretty strong return, but it does get smoothed over time. And if you look at the table at the top, you actually can see annually whether we had gains or losses that are being smoothed out. And in an ideal table, which we are seeing here, you see things in both directions. You see some gains, you see some losses, and over time those are being smoothed out. So your actual value assets and your market value aren't actually that far off right now, which is a good smoothing method. Okay? We turn to page 26. At the top, it'll say statistical data. This page shows you a breakdown of the population as of each of the valuation dates. And a couple things I want to highlight on here is if you look at your actives, we do have those broken down by Tier 1 and Tier 2. Tier 1 folks will have a higher normal cost, a higher annual cost than your Tier 2s. They earn benefits at a higher rate than Tier 2. In your case, about 28% of your population as of January 1st was Tier 2. That number should continue to increase, and you should see your Tier 1 number decrease. So over time, your normal cost should come down as a percentage of payroll, just based on the fact that you're hiring Tier 2s generally over Tier 1s. Okay? The other thing I want to point out is looking at your service retirees. We do look at the average age here, and you can see the average age of your retirees is about 68. So you probably will be paying these benefits for a while. It's not that old of a population. However, your beneficiaries are a little bit older here, about age 70. So that'll give you a feel for how long you can expect to be paying those payments to those beneficiaries. Okay. Page 27 says at the top, age and service distribution. What I like to look at on here is really to focus. So what this table shows you is it shows you. Oh, go ahead.
I'm sorry.
No, not at all.
Sometimes this doesn't matter, but I think in this particular case it might.
Okay.
With respect to the service retirees and the beneficiaries, those averages are both means?
No, it says simple average.
Yeah, so they're means,
Yes.
correct?
Yeah.
Do you know what would happen if we looked at the median?
I'm not sure. I haven't done that and looked at the distribution here. It's hard to say. I guess I would assume it's probably weeded on younger than that, but I don't know the answer.
Well, wouldn't that be relevant? I mean, it would seem to me that if your average current age, okay, so you've got beneficiaries here, 6, 7, 7, 8, okay? So let's say that you have a 102-year-old beneficiary. That's going to move that average age.
It does, yeah.
And so it would seem to me that I would like to know, and I'm not talking about this from an actuarial standpoint, I'm talking about it from the perspective of an employer. I would like to know, half the people are above this age, half the people are below this age. So if there's a way to easily provide that information, that would be something that I think would be instructive both for the committee and for the city to see. And
the other thing, though, to keep in mind with respect to that, so that would be helpful to some degree. The other piece that's helpful is every one of these folks has a different payment coming out. And the other really relevant information is, if your 102-year-old has a very small payment, in addition to not having many payments left based on our expectations, they're not carrying much liability anyway because the payment is small. So there's a dollar weighting or a benefits weighting that should also
Correct.
influence the liability.
correct, I would agree with that. And that's another reason why it would be useful to at least look at the median of the benefits as well. But, I know that there should be concerns about confidentiality. And, you know, and so we should be, you know, careful with respect to that. I mean, I'm interested solely as a, you know, when you only have 6 or 7, you know, the beneficiaries are the issue.
So that being said, this information is achievable online through the Department of Insurance website. You can look at by individual.
Oh, all right. Okay, never mind.
Well, confidentiality seems like it should be an issue. It actually is publicly available information.
Okay.
I'm going back a page, I still don't understand the difference between tier 1 and tier 2.
So it's a benefit structure change that happened in 2011. In 2011, new benefits were implemented for the police officers and firefighters as well. And so the benefits were basically reduced for anybody hired after that date. And that's how the tier is determined based on your hire date.
Okay.
State pension systems. So that
Yeah,
one too.
yeah, SERS is that way too.
So let's flip to page 11, or page 27. At the top, it'll say age and service distribution. So on the left-hand side is the age buckets by 5-year increments, and at the top are service buckets. And you can look at, where I like to focus my attention on this table is to look at anybody right now over age 50, and anybody right now who has more than 20 years of service. And the relevance of that is these people are currently eligible to retire. So if you look at the head counts in that bucket, there's 6 people, which is about 10% of the population that could retire right now. The other thing I like to look at is, let's back that off 5 years and look at anybody over age 45 with more than 15 years of service who can retire within the next 5 years. We add 13 more people, which is about 20% of the population, which gives us a total of about 19 folks that can retire within a 5-year period, either currently or within 5 years. That's about 30% of the population. It sounds big. I've had some funds that are 57% or something insanely high. So from a workforce planning perspective, I think this information is as helpful as anything, but it also does influence when you can see the timing of those benefit payments coming out of the fund. And this does explain why it takes 13 years for your benefit payments to double. It is about 30% of the population within 5 years, as opposed to some funds where you see higher numbers here. So I didn't feel that these were too startling. It sounds big, but I see crazier numbers in a lot of funds. So helpful from a workforce planning perspective. Okay, so that's what I was going to go through on the funding part of the report. Since Brian focused on GASB, and those numbers really don't have anything to do with what the contributions were going to be, I was going to focus on funding now for fire. Does that make sense too? Okay. So let's flip to the fire report. It says City of DeKalb Firefighters Pension Fund on the front page. It should be about 30 pages past where you were. Pages.
It scrolls very slowly, it scrolls.
Yeah, let me know when everybody's there. I think it's
I don't know how to go to a page. No.
You know, if you've got page numbers up above and there's an open, you can actually type the page number in.
Up at the top bar.
No, it's good.
Okay.
I'm coming around quickly, it just,
That'll make your life
Because I don't
easier.
see it, doesn't mean it's not there.
Just want to make sure everybody's on the right page before we.
yeah, I mean, I don't know, it would be easier. Here's a little different. Yeah. Right. Exactly. Well, one thing you can do is you can search for a particular word, but.
Sure. It is fine.
Okay.
So actually, I'll give you a little bit past that to that page 5 at the bottom. It's a summary report at the top. So again, that's our bottom line on top page, summary report. And this will give you the same information we saw for police, but now for firefighters. Again, the left-hand column will have the current year numbers, the right-hand column will have last year's numbers for comparison. So you can see that the number went up about 10% from last year, from $3.2 million to $3.5 million. It's an increase of about 10%. Again, mostly driven by the change of assumptions and that amortization payment increase that's built in.
What page are you on? fire report?
on page 5.
Okay.
And it'll say summary of report at the top.
For what it's worth, it starts about 300, page 300 in the entire packet.
Okay, so the few things, in addition to the change of assumptions and the amortization payment that increased that payment over the year, we actually had a bit of offsetting experience here because the plan did have some favorable experience, including average salary increases that were less than assumed, and favorable inactive mortality experience, which basically means more deaths than expected. So actuaries have come in with morbid information, it's very sorry about that. But it does decrease the liability to the fund. There was unfavorable experience due to the lack of turnover, more retirements than expected, and again, that investment return on a smooth basis of 6.73%, which was short of what we assumed last year of 7.5%. So again, because it gets smooth, it's not reflecting that full market return that was received in the fund last year. Okay, so let's turn to page 7, which will say changes since prior evaluation at the top. So again, this is pretty similar to police. We changed the interest rate by 50 basis points in the first bullet. In the next bullet, again, based on the Department of Insurance study, we did change the decrement tables for retirement, termination, disability. And then that last bullet, we changed the payroll growth rate assumption, that 50 basis points from 4.5 to 4%. So same things that we did to the police fund, we really implemented here on the fire as well. If we look at the GASB calculation, so GASB 67 and 68 disclosure, where we do have to disclose those long-term expected rates of return by target asset class, the answer here is about 6.67% on a long-term basis without including any asset correlations and all the other things your investment advisors will say increase that number above the 6.67%. So much closer to the 7% assumption here. And I felt like the numbers that we received from the investment advisor here were more in line with what we see with a lot of advisors in terms of looking longer term. And really we are trying to achieve a long-term rate of return here because the fund may in the next 5 years not achieve 7% on average, but over a 20 or 30 year horizon, which is what we're really targeting, we hope that it will. So that's the expectation of 7%. Okay. We flip to page 9. This is the section C, liabilities. And again, focusing on the 3 columns. Far left column will be this year's numbers. And you can see actually when we look at the funded status, we're pretty similar to where we were last year after the assumption changes. So had we not implemented the assumption changes, the funded ratio would have actually increased from 41.1% to 42.6%. However, with the assumption changes implemented, the liabilities did go up, and so the funded ratio goes down to 40.9. So pretty similar to where we were last year, based on the assumption changes implemented.
Well, there's been a lot of information. Can you remind me again why the present value of the future salaries went up? What was the new assumption that caused that?
So we actually increased the salary scale to the fund. We implemented a new table. So the present value changed due to the fact that two pieces actually there. We changed the salary scale and the interest rate is moving from 7.5 to 7, which generally is going to increase all numbers that are discounted back over time.
Right, okay, all right.
Okay. Let's flip to page 11. Page 11 will say E-pension cost at the top. So this is the page where we calculate the recommended contribution. And again, in a perfect world, we are just funding the normal cost of 1.281 plus 34.6 or 34,649, and then subtracting off expected member contributions of 482,000. That would be the ideal contribution we'd be making if the plan were fully funded. However, again, not the case. And we do have that payment required to amortize the unfunded actual accrued liability within a 22-year period, which is 76% of your contribution. So $2.7 million to pay down those past accruals. And that's 76% of the $3.5 million contribution that we're recommending. So So looking at section F at the bottom, you can see that you're again funding pretty close to the recommendation. So the recommendation was 2.990 million, and you funded 2.969 million. So pretty close, almost funding exactly the recommended amount, which is a good thing to see.
So in both of these cases, is it correct that, and this was the question I had before, and I think it got answered here.
Okay.
As a result of the change in the assumptions, the normal cost will be a lower proportion of the total contribution. Put another way, you're going to amortize more of your amortization contribution is going to be high under the new assumption.
So I think it depends on the combination of assumptions that necessarily are in effect here. I think if you were to look across all the columns, that amortization is still about 76% of the contribution in all cases.
Okay, all right.
So everything, because of that interest rate decrease, everything is going to be high. It increases all of the numbers.
And so you're saying that there really isn't much change in terms of the proportion of the total contribution that's normal cost?
No.
Okay.
What would drive that would be more if we change that payroll growth assumption. All of a sudden, that would spike this number quite significantly. If you remember from the police report where you drop down to 0% payroll growth, you go up $1 million in contribution or something like that, it was $900,000, it's pretty significant. That would increase this as a much larger percentage. That's really the only assumption that's going to drive this, because it's the only assumption that only applies to this piece of the calculation.
But again, we're in a situation which we've discussed last year, we discuss every year, and I want to make sure it's out there on the board, that right now, about 3 of every $4 of contribution is to pay down an existing liability.
Yes.
And therefore, if you were to eliminate the police and the fire department tomorrow, you would still have a substantial cost. It may not be as high, because we talked about that last year. You gave a very good explanation of why eliminating the department would reduce a little bit.
Yes.
Not a lot, but
Right.
a little bit. So basically, you've got a situation here where you're not going to save that much money by what you do with current employees.
Yeah, because that is past debt that you're trying to pay for.
Okay.
And those benefits are promised and will be paid.
Okay. Right. Okay.
Okay. So if we flip to page 12, the top, this one will say H, schedule illustrating the amortization of the total unfunded, again showing you the projection of that unfunded accrued liability and how those payments that will in the future pay that down, change that number over time. And again, it's about 8 years before we see that number start to come down, which means for the next 8 years, that large payment of $2.7 million that's paying down that past debt is not even covering the interest that past debt accumulates on an annual basis. So you're not even covering interest, let alone dipping into any principal on that number for 8 years.
This was true of the police too.
Yes.
I want to ask you a question about I-1.
Yes?
From a layperson's point of view, if I'm understanding correctly, is it true that that is the comparison of actual and assumed payroll increases?
Salary increases. So this is looking at people, individuals that are in the department last year, that are in the department this year, and comparing how their pay changed. So anybody who retired or terminated is not included in this calculation. Anybody hired new is not included in this calculation. It has to be people who are in the fund for both years and how their payroll changed year over year on an individual basis.
I'm,
So it's not the payroll growth assumption.
Okay, but you assumed a 4.5% salary increase?
In the past, that was last year, because we maintained the number that had been used before. This year, we implemented a schedule that is service-based. So earlier service will be higher than 4.5%, and longer service will be lower. So the 4.5% was sort of trying to mimic an average on a long-term basis, remember, not the next 5 years, it's long-term.
Okay, so, understood. So this is not the same number as the assumption we were talking about. So you have a salary increase and you have a payroll increase?
They were the same in the past, which is very confusing, and I think we inherited that from your prior action. We didn't maintain that until we felt like we were at a point where we could change that.
And so what is assumed now?
So it's a schedule, and I can actually show you that. Let's flip to page 19. It'll say actual assumptions and methods at the top. And about 2/3 down the page, you'll see salary increases. This is the individual salary increases being assumed and built into the liabilities right now. So you can see it's based on service. So your early service schedule folks are getting higher increases. And then as they achieve higher levels of service, that levels off pretty quickly. At 6 years, they're at 4.5, and then after that, they're actually solid 4.5%. This is a long-term schedule, and it also includes promotions.
I understand this, and I'm not fighting the facts. I just think this is really a red herring, because people are going to view this as, look at all these salary increases that people are getting. When, yes, the salary increased, but there were a lot of factors in there. This isn't a negotiated annual increase in salary. So, okay. I don't think there's anything that can be done, because you have correctly said this is based on an experience study performed in 2017.
That being said, this is based on the all Article 4 funds across the entire state. I have had funds come back and say, we have,
Oh, so this is statewide?
this is statewide.
Oh,
Article
okay,
4.
all right, all
So
right.
to the extent that your fund had, so I have one fund, for example, where they have had 15 years of basically the same schedule that gets negotiated every 4 years. They provided us the contracts, and we developed a salary schedule that mimics their contracts much more closely than what the state schedule did, and that is what we implemented for them. If there was something like that, keeping in mind that this is a long-term assumption, so we don't want to look at the past 5 years where rates might have been lower. We want to really think about this on a longer-term schedule.
Right, and I think the thing that should be noted, and I'm comfortable with this, is the fact that this is an actuarial table.
Yeah.
I mean, this is something that is based upon gobs of experience, a professional term, gobs of experience. Okay, I'm fine.
Yeah, so that's where that came from. Okay, so if we go back to page, actually, I'm going to have you go to page 14. Again, looking at the development of that amortization payment and focusing on the calculation here at the bottom, the amortization amount that we calculated as of 1/1/2018 was $2.5 million, basically. That's with the 4% payroll growth assumption. Dropping that down to 0% and amortizing this number like a mortgage would increase that number by $1,047,000 or $47,000. So over $1 million to drop down to a 0% payroll growth assumption. So big increase to stomach to amortize that. Now what would happen is you pay more now, you pay less later, but it is a pretty hard number to move to. If we move to the middle at 2%, that number goes up by $496,000. So about $500,000 to drop down to 2%. Still a pretty big number. So we did decrease this 50 basis points this year. We're comfortable there now, but this could be something we'd be coming back to you with in a few years and revisiting. Okay. So if we flip to page 16, just to point out again, this says at the top, reconciliation of changes in contribution requirement. Line 1 shows the contribution last year. Line 3 shows the contribution this year, and all of the things that moved that from year to year. So the big increases again were that assumption change, increased the payment by $244,000. And then the annual, every year we'll see about a $100,000 increase in amortization payment due to that payroll growth assumption. The fact that we're assuming payroll growth basically guarantees about a $100,000 increase to the contribution every year. So all else being equal, if we make no assumption changes next year, all assumptions come true, we can expect our $3.5 million to go up to $3.6 million, just if all expectations come exactly true. Okay. So we've looked at page 18. This one says at the top, projection of benefit payments. And again, focusing on, so we described how the actives and inactive columns are generated, focusing on the total payment column of the expected benefit payments that will come out of the fund on an annual basis. Looking at that 2018 number of $3.5 million, that's about 12% of your market value of assets. It's a little higher here than it was in police. Police was 9%. But again, not terribly jarring to see that number. I'm sure that your investment advisors are managing to it so that they keep enough assets liquid to manage that. But you can see a 12% draw on that. And then in your case here, it's about 16 years before we see that number double. So again, there's some time for your monies to work for you as they are invested in this fund. Okay. We flipped to page 24. So this page will say at the top, actuarial asset valuation. This shows the smoothing methodology again. And again, you can see that the market and actuarial value are pretty close at this point due to the fact that we are smoothing both gains and losses in that table at the top. But again, I wanted to point out the actuarial asset rate of return. The actuarial asset rate of return was 6.73%, which we're calling a loss. But in reality, the market value of assets actually experienced a gain of around 12%, a little higher than that, I think, when you dollar weighted. So the fund did pretty well last year, and that's hopefully a continuing trend. So contributions come from two places, either the municipality or investment returns. So you hope to see the investment return be above your expectations so that you can see your contributions come down. And then let's, with that, flip to page 26. At the top, this will say statistical data. So the top two categories are those actives by tier, tier 1 and tier 2, based on the 2011 changes in benefits. And you can see you had 38 people in tier 1, 19 in tier 2. So about 1/3 of your population is already in tier 2 and earning less in the normal cost numbers. So over time, we'll see this number grow and the tier 1 number decreases. The normal cost should come down on a longer-term projected basis. In this case, if we look at your service for retirees, the average age is about 66, so similar to what we saw for police. But your beneficiary age is pretty young, so we're seeing 57.7 here, so it's a much younger age. I have not gone back and looked at the data here to confirm. It wouldn't shock me if it's showing younger because there could be children in that benefit, and the children benefits expire at age 18, which won't carry much liability. So to your point about the median, I think the other important distinguishing thing to note here is if you do have any children in these numbers, they're not carrying much liability, but they are drawing this number down, which might be what's going on here, because it did change from 2015. You can see it did change quite a bit. Okay. We look at page 27 then. So again, this is that age and service distribution. It says at the top. You look at the age on the left-hand side of the table, service at the top, across the top, and focusing on anybody with more than 20 years of service over age 50 right now. We have 9 folks in that category. So 9 of the 57 people are currently eligible to retire, which is about 16% of the population. If we step that back 5 years and look at anybody over age 45, anybody with more than 15 years of service, we add 6 more. So there's 6 more people that could retire within 5 years, for a total of 15 people out of the 57 who could retire within a 5-year period. So that's 26% of the population. And not a startling number to me. It's not surprising to see that because you do do have quite a bit of time before that payment actually doubles. When we looked at the benefit payment stream, so we don't expect that to change that rapidly. But something I always like to look at because it does alert us to the fact that payments might change dramatically, and it also helps from a workforce planning perspective. Okay. So with that, that's what I had with respect to the contribution calculations in the police and fire plans. If there's any other questions?
If you have any questions, Betsy, you're free to ask.
This is way over my pay grade.
I'm
Confused.
Well, it looked like the fire,
We're struggling here too.
the fire matched almost dollar for dollar, the contribution and the payout were the same. Right? Did I read that right?
In terms of the benefit payments that we're
Yeah.
making, that could very well be. That's coincidental,
I
though.
know.
That's not, yeah, that's not all intentional.
Yeah.
You'll notice though, I
Almost.
believe the firefighters are considerably younger. There's, right now, there are 9 of the 57 who are 25 to 29. They don't have a lot of service. But, you know, you've got 17, you know, 17, so that's 30% that are 35 or below. And you've got half that are below 40. Yeah. Anyone with any questions? Anybody? Staff?
So, what I want to note is, for, I'm sorry, I'm late.
We had another meeting.
Joint Review Board for TIF. So, the funding amounts for police and fire pension, if you go to our city's financial policies, police and fire pensions are listed under 1A priority with IMRF to be fully funded through property tax levy. That is not the case in this year. Police and fire, well, no IMRF is funded through property tax levy. And police and fire, it's about $450,000 to $500,000 that is funded by other general fund sources in the current budget.
You mean FY18?
Current budget, yeah.
Okay. All right. Well, we'll have a discussion. Thank you.
Guys, thank you very much for letting me talk.
All right, our next agenda item is continued discussion of the 5-year financial report. And I will turn it over to our jack of all trades. City manager, city engineer, finance director, public works director, airport director,
And moviegoer.
and moviegoer. I was just going to add that, yes. Wow, talking.
The main reason I brought the 5-year forecast back onto your agenda is, one, I know it was a lot of information at the last meeting. Ken went over more just questions about the report. Was to, one, provide you an opportunity if you've delved into it deeper, if you have more questions or thoughts that you wanted to discuss on the report. And you were forwarded email that somewhat pertains to, well, it pertains to the 5-year forecast in that we had a citizen who has provided suggestions on sign enforcement that could lead to revenue potential in the general fund.
Yeah, I have talked to Mr. Feldman. I actually talked to him quite extensively before he sent the email and suggested that he send the email so that, his idea would be put forth. It was put forth as an idea for an alternative revenue source that would be consistent with city goals, and he was concerned that, that there was not being adequate enforcement of some of the well-thought-about ordinances, and that maybe we could kill two birds with one stone as a city, that this would be a way to make sure that the beautification, aesthetics, and consistency of signs was done, but also as a secondary, he believes there would be a substantial revenue opportunity. You know, it's a revenue opportunity. I think he said 300 or 400,000 was his estimate. If he were to be correct, that would be in the realm of what we used to be spending in the streets. So I don't think that it's necessary to have an extensive discussion about the particular proposal, especially since it was not on the agenda. But it is one example of an alternative revenue source that might possibly be considered as we go through the budget process. And if you're generating $300,000 or $400,000 a year, if that is a good number, that would be a substantial contribution in the budget discussions, because we've often been looking for items that are in that particular range. So, other reactions?
Well, I was interested in that because I was on a committee back in, let's see, 2008, 2009, to review the sign ordinances. And I'll tell you, I don't think anything ever came out of that committee. You know, they were talking about where they could put signs and on the corner of First and Lincoln Highway. You know, there were problems with viewing and it just, nothing ever happened. And I think part of the problem was there's nobody to enforce signs. You know, which is, there's, you know, the 300,000 or 400,000 or whatever, certainly had to take into consideration the cost of someone that's, you know, can enforce it.
Well, you know, I think to be perfectly honest with you, I think that there, and this is based on my discussions, there were two comments made that were relevant. Number one, that this gets taken care of in the approval process. These are not a matter of going out there and enforcing somebody who's not compliant, because they have to come in every year and get their sign permit. And I think that one of the observations that he made was that we have a lot of things that are on the books that the city, for one reason or another, has chosen either not to enforce or not to enforce uniformly. And that can be problematic. I mean, there's been a lot of concern about the flashing signs, but there are also rules about signs that are extending off of buildings in the downtown area. And complaints from some citizens, I'm not laying this on Mr. Feldman, complaints from some citizens is that the approval of your sign depends on who you are. And that is not the way that's not the reputation we want to have in the community. Either make the same opportunities available to everyone, or not. And you know, I'm not trying to favor any business or the like, but I can tell you that with respect to our facades and our signs, that's one of the reasons that a very, 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 very low percentage of people that go through DeKalb or even walk in Hotel know of the existence of the formerly known as Paperback Drive. Because, you know, it doesn't call attention to itself. And that can be a function of what you allow with respect to signage.
Well, getting back to enforcement, I still think there's gonna be a lot of businesses that are gonna put up whatever they want until somebody says, hey, you can't do that without getting approved.
Well,
And all you gotta do is look around.
right, no, I mean, and the same thing goes, Steve, with respect to building permits. You know, and so, you know, another aspect of this was, I'm trying to think of the other thing that was brought to my attention. That there were rules, and they just simply are not being enforced. And, you know, it's a challenge. But, you know, I think the message to the committee, and the message that I would bring for feedback is we should look for some things that are relatively low cost in terms of implementation, in the sense that, oh, I know what the other one was. Low cost in terms of implementation, at least in terms of the ordinance already being on the books. It's a heck of a lot easier to enforce an ordinance that's on the books than to go through the process of creating an ordinance and then trying to, you know, enforce it. Another one that was brought to my attention was amusement games. That there's a very, very large number of amusement games, and I'm not talking gambling, in the community that are not licensed. And there is a licensing statute, or a licensing ordinance. And, you know, it doesn't take that long, seriously, to go around and say, you know, you got one of these claw games, you need a license. And it's hard, I will admit that it's hard to be uniform with respect to that. And we don't need to look any further with respect to the difficulties of enforcement than to the Otto's property. And the problems was Otto's, wasn't it? That the problems, or was it Lord, no, it was Lord Stanley's. Lord Stanley,
yeah.
where it was found on a routine inspection, but when you saw all of the mold, et cetera, that had been there for a long time. Well, obviously, a routine inspection had not taken place on a timely basis.
I'm
because
confused, are we talking about signs or buildings now? What was
we're
that?
talking about enforcement.
Okay,
Okay,
I get
so-
that, but define sign, are they talking about a street sign that's lit up, or a sign I put on the side of the building?
Anything that you,
Hang a banner on there?
If I put a banner,
yes,
because,
that's a
because
sign.
nobody will allow me to, put up a neon sign?
Yes, that's all
So what
included.
is he saying, there's 100 illegal signs, why are we defining illegal signs?
So signs that could be placed in the right of way, didn't go through the permit process, are created outside of the sign standards of the.
And didn't kind of.
Yeah.
through the
But
process.
essentially, Ron, if I understand correctly, and I haven't read the ordinance, anything that protrudes from a building, okay,
Is a sign.
no, anything that protrudes from a building is non-compliant. You cannot have like an awning. Those are all not allowed in the downtown area. And so, another example is where you have like sign, the hook that protrudes and then the sign.
Yeah.
Okay, no, that's against the sign ordinance.
Why
In my
did this
opinion,
become,
that ought to be changed.
why did this become a problem? Are we doing this for quality or to raise money? I mean, I'm curious why this,
No,
it seems
this-
like there's bigger issues
So,
than worrying about signs. I agree there's gotta be some standardized, but how did this become?
for sign enforcement, it's part of the community development department.
And it gets back to our discussion for this whole budget of what are the service priorities in a department and where do we allocate our resources.
Okay.
So community development has been very active in focusing on economic development and other things. We haven't been as active in sign enforcement.
Okay.
It's come up quite frequently because we do have the one citizen who feels very passionately about sign enforcement and regulations with signs.
Okay.
So it's not that sign enforcement isn't a need of the city and it isn't a service that we would provide in, it's just that right now the current services that we're providing through the department, sign enforcement isn't as high up on the priority list
Okay.
as other services at the moment.
But one of the problems is that, and you know, this is all public, okay? We had a member of the city council, no longer a member of the city council, who wanted to violate the sign ordinance and basically felt that he or she had the right to violate the sign ordinance. And, you know, to heck with everybody else. And to me, it was pretty egregious.
Sure.
You know, I mean, there are different rules with respect to signs, and there are different rules with respect to development. And I think there's a concern that some businesses are getting a break when others want the same thing and can't. And, you know, I'm not taking a position on that. But I mean, you know, some people believe that, you know, which I do not. Some people believe that anything that has Mr. Pappas' name on it is bad for the city. I don't believe that. But I am concerned when you had decisions being made about a reduced size of the sidewalk. Did we not on First Street? I think on that property that it did not have to meet the full setback. And, well, yes, that kind of project is very, very good, but we need to have a very clear idea of what are the criteria that we will use so that we're consistent in dealing with each of these issues. Now, whether it's a priority or not is something that the city has to decide. And you know, I think that it also is a matter of making sure that our ordinances are supportive of our larger goals as a city. You know, your facades and your signs in a downtown area are going to matter.
Yep.
Well, I think when you talk about priorities, although it's not the only thing, but how much revenue can be generated by an activity? You know, at the sign, I mean, I have no problem with this.
Absolutely.
You know,
You want
this
sign?
sign, if we can generate that much money,
So
that's a good thing.
So this citizen believes that the city is losing $300,000 to $400,000 in fees or fines by not enforcing. What's up?
I think
Did you see the, here's the email, if you want to read it. I didn't print it out.
But I agree when I'm talking about signs, one of the things, what I remember is you couldn't have any lighted signs with scroll,
right.
except for banks, they can do it. I mean, that's where I can see where some people say, that's not, why can they do it, we can't?
Well, and there also is a part, I remember this coming up. There is, in the sign ordinance in DeKalb, there cannot be a face or the likeness of a person. And it came up with Kentucky Fried Chicken.
Yeah.
And so, you know, I mean, that's just a factual
So
statement.
I mean, that may be one of the things, we gotta really look at the sign ordinance. See,
Well, I think, that, and it's a matter of making sure that we don't put the chicken before the egg. But let's not lose track here. We're trying to put on the table alternative possibilities for raising revenue. A citizen has put one forth that when we talk about that
Oh,
sort of
you're
thing,
welcome.
we can.
I'm not sure, if back when I was on that committee 8 or 9 years ago, there was somebody who was very adamant about people that were abusing it. I'm not sure if it was the same guy or not. But maybe it was. If he's that passionate, he might have been.
Well, when he talked to me, he was talking to me in the context, seriously, he was talking to me in the context of what he thought was best for the city. It would, there was no disrespect and no, there was no axe to grind. It was just a matter of, we can kill 2 birds with 1 stone, we can get better use of signage and signage ordinance, and we can also do it in a way that will raise some revenue. Now, if some of that gets taken off for enforcement, so be it.
I like those type of citizens thinking that way, rather than the some that complain about everything but have no solutions.
So I will make note that I have not gone through and even kind of verified the estimates on this. This is just the citizens' thoughts on what that could generate. But also, I think that this wouldn't be a recurring revenue. If that was the case, a lot of that, once you start the enforcement, then people.
But if it's a permitting,
Right, so part of it was permitting, part of it was for enforcement, so the enforcement part might be more on the one side of the house. And we haven't looked at the cost too.
That's always the thing, though, is that we enforce, if we don't enforce stuff,
right.
And it's like, it falls by the wayside, like you were saying,
And then
with the city inspections and stuff, and then. that's
People
what-
would rather, ask for forgiveness, permission.
Sure.
Right. On some of those ordinances aren't that easy. If I remember right, there's like a pretty complex formula, how many square feet your sign can be as compared to what your facade is.
Oh, yeah.
Right.
Not altogether easy.
Exactly. No, it certainly is not. And you need to balance off being friendly to new uses of buildings while also wanting to maintain some semblance of a reasonable character for what you want. And the large corporations, if you look around, a lot of communities have very different regulations with respect to the way that you do site planning. I mean, if you look at McDonald's, they make many different architectural decisions if they want to go into a community. I saw a Panera 2 days ago that I don't know what was in there before, it was a McDonald's or what, but I mean, it had no look that was similar to any other Panera that I had seen from the outside.
DeKalb tried to do that, remember with the McDonald's that just made the news with U2, I always remember that years ago, they wanted the new architecture, and McDonald's says no. I just remember as a citizen, take it or leave it, and the city caved and let them build it on. I remember thinking, you should have let them walk, because we're giving them, you know what I mean, they had prime space down there, and they caved in, let McDonald's tell the city that they were gonna put in architectural. You're right, I've been in Naperville, those places, they have Bloomington Normal, your favorite, they have themes of the buildings, and they make them tie in the architecture.
But you need to have more,
Yes.
you need to have already established that.
Correct, you
do
can't
it
just start
business
at
by
hodgepodge,
business.
no, I agree, that was the problem,
Exactly.
out by the junction.
Anyway, other questions or things you want to discuss about the 5-year plan?
Can I just have a comment?
Sure.
I got the email on the packet, I don't know whether it was Thursday or Friday, and I had Ruth, who's kind enough enough to print me out this. But I don't, there is no way that a normal person would be able to look through this information in a short period of time. Why can't we have, we're gonna have a meeting, we're gonna get the packet on Thursday or Friday, make the meeting a week from Tuesday. So you actually have some time to look through this. That's just a comment.
I did send some of that actually earlier in a separate email when we got it, but it could have been missed.
Well,
So I did try to give it.
the 5-year plan we've had
Right,
forever.
the audit.
Yeah, I've been trying to send them earlier as a separate email, so you get it, but maybe I'm just not, it might not catch your eye because it's off from when a meeting is. So maybe.
Well, I missed the last meeting, I sent you an email, so, because I thought I missed the next one, but it was pushed back, which was.
Okay.
Yeah, but I'll try to make that more prevalent when I send stuff a little bit earlier. I think it's out of routine.
Well,
Because I do, no,
and then
it's.
you're welcome to jump on me, but get it earlier, and still have it. So,
No, I mean, it is an immense, it is an immense undertaking. And I can't handle that amount either, you know. We're fortunate to have 2 presentations tonight and very patient presenters who were willing to go through the report. And,
well, yeah, just a comment about that, back when I started in Northern, started as a major in math, decided I didn't want to do that, thought being an actuary, that could be kind of cool. I don't think it could be kind of cool now.
I'll tell you, it's one of the best professions. I went to undergraduate school at a place that had a good ag sci program. Northern has an ag sci now, but it's there will always be jobs. There will always be
I mean, you
jobs.
can drive yourself nuts, though. Well, maybe I better change this 1%, and it changes everything.
Well, it does. No, I mean, that's what shows the complexity of what we have to deal with. But yes, I think your point is well taken. We need to do the best that we can in terms of anything that we expect people to read before.
Yeah, I will try some, or like we did today, I know the 5-year forecast I didn't get out as early as I would have liked to have gotten to you, to bring it to a second meeting, so you have more time between the 2 as well.
One other comment, we got the audit. What do we have current financials, through what date that we can be looking at the current numbers?
Yeah, that was on the last meeting, that year-to-date information. Did you get that packet from the last meeting? I know
Well,
you
that's
did.
the one I couldn't make, is our
Right.
6th grandchild was being born.
Right.
And I went in, and it was a false number. So, we had to stay with it, yeah.
So we went over it last meeting. the
Okay, so
year-to-date.
it'll be in the packet that was sent before,
Yep,
and that was
but
through when?
that one was through April, but
Okay,
it's usually the second meeting of every council meeting. It's on the consent agenda that you'll see the year-to-date.
Oh, okay.
So we have,
Okay.
so it'll be updated if you want more current.
So if you look in the council agenda,
Okay.
every second meeting, they'll have an update.
Okay.
I haven't done it recently.
But yes, the one that was presented last week is what I really use to help drive some of the information that we have and the
All right.
financial.
Good.
Okay, next meeting, I cannot do the next couple of Tuesdays, so, can people do a Wednesday?
I said what?
Could you do the 12th?
September 12th?
Same time, same place?
Probably, let me check, I'll just hire somebody that's gonna help with my plan up, so yeah, you wanna change it to the 12th? 5 p.m., same time, 5 p.m.
Is that,
During board meetings, so Susan.
I will
does that
say,
work okay for you?
yes, I'll just have to double check that, make sure. it
Yeah,
works.
we can change that to the 12th.
If not, could people do the 13th as backup?
Yes, I can
Either
do
one's fine.
Okay. So let's,
I'm gonna try for the 12th or 13th first.
12.
Okay. I will follow up with,
Tom
you and, yep.
and Lynn. All right, I'm going to open for public comment again, as I do. Do you wish to speak?
Sure,
Okay,
why not?
please.
Keep meeting. The more often this group meets, the better off we're gonna be, because we really need your input. We have a treasurer in Molly, she really kind of knows her business, and the more we can get your wonderful input too, the better we are gonna be in solving our financial challenges. I still don't like the meeting location, I'm gonna keep saying that. I had a buzz to get in, this poor guy had to come and rescue me, get me up on the elevator, so I wish we could just be in City Hall. If that's where it belongs, and poor Ruth wouldn't have to hightail it all over here from City Hall, and Molly too, so anyway. I'll just keep reminding the chair of that every once in a while. Sources of revenue. That's good. I suppose that's one of the things that the FAC should be doing, looking at various sources of revenue. But also, as a citizen, and somebody who was involved in City Hall quite a while ago, citizens also like to look at ways of being more economical, cutting back, and utilize, making do, instead of just looking at other sources of revenue, because people have had it up to here with being the sources of revenue. You know what I'm saying? It's hard. It's challenging for the average homeowner and property owner and person to make it as it is. So maybe thinking more towards what are some ways that you can, as a committee, look at cutting back, maybe consolidating certain services and so on and so forth, that would be more economical. I had thought about that. I was, and I haven't talked to Molly yet about it, but the staff is going to want to change the website. Our website isn't very good, if you haven't noticed. And I was thinking, they're thinking of doing it like in February, which seems like a long ways off. And the city also has a lot of Facebook pages, and they have that new email newsletter, which is very nice. It's a very nice feature. But I'm just wondering if maybe we could cut back on the Facebook, all of the different ones, and just have one, and maybe forgetting about the e-newsletter and somehow consolidating that and putting the effort that it takes and the staff time that it takes to do all of that, and concentrate on revamping the website where, more of that could be, consolidate the workload, I guess is what I'm saying. Maybe you could look at that. I don't know. I don't know how far into, because I know you said you don't like to micromanage, but maybe asking a few of those micro questions might help you give some good suggestions. And then this one, I'm sorry to hit you with this one, but something that this community has been concerned about for a long time, and I know Molly has been right in the middle of this too, is the situation that we have with the library. It seems as if we're going to continue to do battle there. I don't know what's going to happen on that front, and I don't know if or how the FAC could or should get involved in that in any way, shape, or form. From what I've observed, I think things haven't quite been done correctly at the library over a period of time, ever since the expansion started, and somehow things are just not meshing together the way they should. And now we have the issue of the levy and all of that, and returning the monies and blah, 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 blah. It seems as if there could be a much easier solution to all of this than what is being worked on now. So I don't know how deeply involved. You're the folks with the chips and the accounting stuff in your heads. Me, I have a hard time balancing my checkbook, but, yeah, you might be able to see something that nobody else has seen yet. So, how's that for a homework list?
Let me respond to the last item, because it's one that I have more of a statement than some are aware. I take it personally that this has gotten screwed up.
Yeah.
Because I went over and I talked to the director of the library, I talked to the chair of the library board, and I talked to two other members of the library board at the time that this issue came up originally. They provided me with all of the legal documents, and we had a very good discussion, and there was going to be no issue. They knew what they had to do, they were committed to that, and I suggested that the city council make an intergovernmental agreement to assure that the reduction, the abatement of the taxes, would take place as everyone understood that it had to be. As a show of good faith, and I'm not criticizing it, but as a show of good faith, the city council chose not to require the intergovernmental agreement. You know, trust but verify. That it came up and they said, no, we're not going to do the intergovernmental agreement. And I think we wouldn't be where we're at right now. It would be, you know, there's an intergovernmental agreement, you agreed to do it, and
But there is an agreement.
There's not a formal legal agreement.
Ah.
To the best of my knowledge, there's not a formal legal agreement. There was an understanding. It's in the minutes. But you had a change in the library board, and suddenly they decided that they were going to not handle it the way that had been agreed. This was supposed to be all very straightforward and basic.
I'll look it up for you, but I'm pretty sure there's a written agreement. I don't know, Molly would know
Yeah,
better.
the paper indicated I got the impression it was a legal hang-up, that everybody wants to do it, but that because of some
No,
legality.
Look,
Anyway,
there is absolutely no problem with doing it. It's that some people want it done in a particular way. And I'm not going to get into an extensive discussion of this, but there was a way that it was to be done, and it's supposed to be done through the property tax bill. And there's a number of legal reasons why you want to do that, and it's not comparable to some of the other.
I mean, we've talked about it in the past.
You know, I mean,
It was a sticking point.
it's, you know, so.
If we would, if that would be returned.
Yeah. So anyway, I think, I thank you for your comments. The only thing I have any expertise with, and it would have to be considered in the process of some of the things that you suggested, is it is typical for a police department and a fire department to have separate Facebook pages and to utilize those for purposes that are outside of the general city. But I think conceptually what you've suggested is
if there's a way to
absolutely right.
consolidate or to, if there's a way to lessen the staff time being.
Right, no, absolutely, absolutely.
Because there's plenty of stuff to do out there.
You know, I think that I think that it's important that you consider both sides of the budget. Neither cuts or efficiencies should be off the table, nor should additional revenues as necessary be off the table. We just need to find what's best and what's best for our community. Best practices may not always fit with what a community needs. Other questions, comments? Motion to adjourn?
Second.
Non-debatable motion, all in favor say aye.
Aye.
Opposed?